173,000 in July, below the 100,000 jobs that economists expected would be added. The unemployment rate rose to 4.2%. That was above a prior read of 4.1% the month before. Now, revisions for May and June were quite substantial. The change in total non-farm payroll employment for May was revised down by 125,000 to just 19,000 jobs added. And for June, it was revised lower by 133,000 to 14,000 jobs. Pretty dramatic moves here. And joining me now to talk more about the markets, the busy week that we've had, and of course, this July jobs report is Jay Woods. He's a chief level strategist at Freedom Capital Markets. Jay, always good to have you in studio, especially on a day like today.
Yeah, it was supposed to be a slow Friday in the summer, and it's going to be anything but.
Exactly.
This jobs number took a lot of people by surprise.
Yes.
And it leaves people guessing, like, wait, couldn't the Fed have cut at this meeting? Because that dual mandate inflation has been sticky,
Yes.
not going down, but not really rising as much as people had feared with these tariffs. And now unemployment back to 4.2%. That's the fourth time we've had that reading. It seems like a ceiling that we're knocking on, and it could go higher. So to me, it could lead for a very interesting day here.
You know, it is interesting because this report would indicate, and certainly we see in the futures market, that the Fed could be more likely now to cut in September. Yet in extended trading, the futures market not really changing much on this. How do we think about that, of course, as we look to the next Fed decision?
Yeah, well, we have a playbook. This happened last July. Last July, everyone was waiting for the first rate cuts, and they didn't happen, and people were claiming he was too late to do it then. And then 2 days later, the unemployment number came out, and it spiked, and everyone's like clamoring for rate cuts. We ended up going 50 basis points in September. So listen for that narrative to heat up. Anyone talks about an emergency rate cut, they're out of their minds. But my thoughts, not yours. But right now, it looks like if they had this number 2 days ago, if they saw what these revisions were, then they could have easily cut 25 basis points ahead of this number. So now we're going to watch Jackson Hole in a few weeks when they go away on their annual retreat.
Yeah.
We're going to get more clamoring from the dissenters saying, look, we told you so, and it sets it up. In fact, right before I got on the air, I looked at the CME Group odds. They were 44% rate cut odds for a quarter point in September. Now they're up to 75%. So it looks like September is not only back on the table, but fait accompli.
So we did get inflation data out yesterday, the Fed's preferred inflation measure. We know, as you referenced, the dual mandate, obviously jobs and inflation. How does inflation factor into this?
Well, inflation is what we call sticky or stable, as if you want to put a better term on it. So it's not going down, which is what the Fed was hoping for, but it's not, this fear of the tariffs, uncertainty causing it to rise still hasn't been felt. And now with the tariff deadline coming today, the tariffs weren't as bad as people expected. We did back down and give a little more timetable to some countries. Mexico, a lot of jokes with the taco trade in Mexico being made now. Yeah, I know, awful. But that's another 90 days down the road. China negotiations continue to go well. Canada's the sticking point. But the other tariffs, not going to move the needle too much. And then the earnings have been pretty solid. Microsoft, to me, was a very interesting tell from a price action as a technician. To see it have a great quarter like it did and open at the highs, close at the lows, that could be a sign, just like the Qs did the same thing, and the S&P did the same thing, opened at the highs, reversed. So I think we're going to digest things, have a little bit of a correction here. But guess what? If we go down 4.25%, we're at the rising 50-day moving average at 61.23. So to me, we're probably in the midst of a normal, healthy correction. And then August, September, you put the backdrop seasonality behind it. This is what we tend to see, a lot of volatility. Remember last August, the Japan yen carry trade, when people were freaking out? I was Googling what the hell is the Japan yen carry trade, to be honest with you. But we need a headline when you get a pause or a digestion of some historic gains, which we just had. The headline now is the unemployment number, the failure to cut rates, and then of course the tariffs. So it looks like we're going to be struggling to get back above 6,400 anytime soon.
So I do want to focus on that word healthy. You mentioned a healthy pullback, if you will, right, of just about 5%. That would still keep us at the 50-day moving average according to your charts.
Yep.
We did see, and we have seen, in fact, companies tap the capital markets amid this historic V-shaped recovery. They have felt comfortable about going public. Figma, for instance, yesterday up 250%. So even though some seasonality might be at play, of course, this environment with a healthy pullback could be in store as well. But long term, is the picture any different in terms of the market momentum that we've seen?
No, I think long term we're in a great spot. And that Figma IPO, chaos down here yesterday, a lot of fun.
Yeah.
It's good to see this building just booming. What that has done from the people that I talked to is got people very interested in calling their banker and getting more deals done. Our president, Lynn Martin, was on CNBC yesterday, and she was talking about how the pipeline is robust and things are looking to go. Well, all-time new highs just yesterday. Let's remember that. That would lead to the pipeline really coming to market. The retail investor has been looking for it. I think it was a little overdone to the upside, but kudos to the Figma people for holding out, not doing that deal with Adobe and going out on their own. Wow, it was a home run, and we'll see if it can keep to these levels. I think it's up in the pre-market again, but it shows, one, the retail investors looking for something new. Two, these companies that are testing the public markets, those that have a good story are really being received well. And a little, turbulence August, September, normal, healthy in my opinion. And, that V-shaped recovery, as you had mentioned, that top of the V and then where we broke out above, that's the level where I think if we get back down to that 6,000 level, we should be buying and set up for a nice year-end rally again.
All right, Jay Woods, Chief Global Strategist at Freedom Capital Markets, joining us in studio at the Stock Exchange. Jay, thank you as always.
Thank you.
All right, well, up next, one